Good morning or good afternoon, everyone. We're so glad to be here with you all today. My name is Brianna Gordley, and with me presenting today is Ann Bedore. We're with Texas Appleseed, and we're going to be talking to you all about the economic well-being of Black families in Texas. Texas Appleseed is a public interest justice center, and our nonprofit really focuses on changing the unjust laws and policies that prevent all Texans from realizing their full potential. Ann and I both work on the Fair Financial Services project here at Texas Appleseed. So one of our main priorities is aimed at promoting financial well-being for all Texans through fair market products and consumer protections. So here in the United States, we have two different types of financial service systems. On the right, we have the mainstream financial system, which are services offered by banks, credit unions, consumer credit companies, and so forth. And this system is very low cost, and it really enables consumers to build wealth through accumulating savings and developing a positive credit history. Through this system, loans are structured with lower interest rates and more affordable payback plans, resulting in less likely means for default, allowing people to more easily achieve home ownership and build their wealth. And then on the left, we have the alternative financial services system, which operates outside of commercial banking services and instead offers products like check cashing outlets, payday loans, rent-to-own products, and so forth. And the financial products under this type of system are extremely high cost with skyrocket interest rates and often trap consumers in a cycle of debt. There's no opportunity to build credit, and when payments are defaulted, some of those debts can even lead to criminal charges on the person who took them out on the consumer. So consumers operating within this system have to find very creative and innovative ways to purchase home products, but those ways often lead to detrimental asset loss. And so here in the middle, you'll see a thick red line, and that divides these two systems because it is very difficult to cross over from one system to another, especially going from alternative financial service systems to mainstream financial services. And then as you can see here, the mainstream financial services typically operate within white upper income communities where people in this system can build wealth and gain assets. And for alternative financial service systems, my apologies, they operate usually in low income and in communities of color, where people who are operating within the system have no ways to build wealth, no ways to build assets, and really no financial benefits overall. So how did we get here where there are two very great divides, where it's very difficult to cross over, and more importantly, why are communities of color left out of the mainstream financial service system? And ultimately, it all traces back to slavery. So from 1619 to 1865, slavery was legal here in the United States, and the vast majority of slaves could not legally own land, assets, or otherwise accumulate wealth. So following the Emancipation Proclamation, when the Civil War ended, newly freed slaves really understood the value of home ownership and land ownership, and they knew that it was essential in building their wealth and defining their freedom. And so despite initial land distributions following the Emancipation Proclamation, the federal government really had no true plans to really provide Black people with any type of restitution post-slavery. And so the land that was given to them under Abraham Lincoln's presidency was soon taken away after his assassination by President Andrew Johnson. And so although slavery had been outlawed, we all know that discrimination still persisted, and it manifested in new and different ways. So many banks refused to lend to Black people. And if they did, the terms of the loan were much more burdensome compared to the ones for white folks. Black people and families had to really rely on installment and land contracts to finance their homes, and these were continuously subjected to discriminatory and predatory practices. So when the Great Depression started, when the stock market collapsed in 1929, there were devastating economic impacts on American families. And by 1933, half of home mortgages defaulted during this time. So in response to this vast economic crisis, the federal government wanted to step in and make sure that home ownership was more accessible. But in the implementation of this process, additional discriminatory barriers were set in place for Black people who were just looking to build homes and access wealth. And the federal government was able to kind of accomplish building additional barriers by introducing a practice that we know today as redlining. So the Homeowners Loan Corporation was established during the Great Depression to measure the risk of foreclosures on home loans. And this process took place by assessing different communities and neighborhoods for risk and assigning them different ratings. So the HOLC developed these maps. They were color coded and they contained outlinings of the best and the worst communities to live in. And so the best areas, which were predominantly white lived household areas, were outlined in blue. And the worst areas were outlined in red, were typically lived and housed in by Black communities, and were seen as having detrimental influences and undesired populations, hence the term redlining. And so the impact of these redline maps subjected Black people that were just seeking home ownership to much higher interest rates and underappraised areas, which really reinforced this idea of segregation. And so when the Great Depression did end, it was very clear that in the US, the single most important means of accumulating wealth for most families was home ownership. But with racial redlining becoming a very dominant practice, and with lenders outright denying home mortgage loans or offering extremely predatory loans to Black people, very few Black families were able to achieve home ownership during this time. And so to combat this discrimination that was so prevalent in the Black community, in 1986, housing discrimination was outlawed with the implementation of the Fair Housing Act by President Lyndon B. Johnson. And it was supposed to prohibit housing discrimination based on race, religion, national origin, and sex. However, by 1970, the average home ownership rate for all US households was 62.9%. But for Black households, it was only 41.6%. And so in the 90s, again, the federal government made the push to open up the mortgage market, but this time to help historically excluded families achieve home ownership. And Black home ownership did begin to rise. But this desire for Black people to achieve home ownership and this desire to acquire loans to do so really opened up an opportunity for predatory lenders to offer subprime loans. And subprime loans are ones that start out pretty cheap, but do tend to get more expensive for borrowers that have low credit. And so for poor Black households from the 1900s into the early 2000s, they were really plagued by these subprime loans, which were meant to help them build wealth and help them achieve home ownership, but ultimately left them worse off financially. And so this practice was actually considered reverse redlining because Black communities were the ones specifically targeted for loans, but for abusive and predatory loans. And so with the market collapse in 2008, over a 4-year time period from 2005 to 2009, the net worth of Black households declined by 53%, while white households only declined by 16%. And so again, in the US, wealth is likely the best indicator of racial inequality in the country. And in today's present, in 2022, we still see the racial wealth gap very clearly and very present. And it's resulted in this generational cost where for 246 years, slaves were the main source of wealth. And then for 100 more years, a conglomerate of laws excluded Black people from building wealth and further widened the racial wealth gap. So every 3 years, the Federal Reserve System publishes the Survey of Consumer Finances report, and this data provides a striking picture of the racial wealth gap over the past 15 years. So from 2016 to 2019, the gap widened yet again, but this time to an astonishing $165,000 between Black households and white households. And this is a $15,000 increase from 2016. And so a major reason for the large racial wealth gap that we see here today is the historical and structural discrimination in our economic policies and practices that purposefully disproportionately affect Black children, families, and Black households. And so looking at history of discrimination, we have 3 maps of the Austin area that are each looking at different characteristics. So the map here in the middle is the original redlined map of Austin in 1935. And so what you'll see on the left is the map that shows the prevalence of predatory lending throughout Austin communities in 2017. And you can see how these darker pink areas where predatory lending is more dominant closely mimics the red line areas in the original Austin 1935 map. And on the right, we have a map that shows the income for adults at 35 years old who grew up as children in these redlined areas, in these lower quartile areas of income. And we can see that the kids who grew up in poverty in these redline areas stayed poor into their adulthood, starved of capital and investment, compared to those on the outside who were able to move beyond poverty in their family. And so for decades, Black households were intentionally cut off from lending and investment and faced further reductions of wealth and greater poverty rates at an astronomically disproportionate rate because of redlining. And today, those same neighborhoods suffered greater risks and poorer health outcomes from COVID-19, such as lower life expectancy and higher incidences of chronic disease. And so since the start of the COVID-19 pandemic, the US Census Bureau began collecting data that really offers a window into the financial hardships experienced by Texans, as well as a state of economic recovery for all Texas households. And so this chart specifically focuses on 4 economic factors: loss of experiencing employment, food scarcity, housing insecurity, and difficulty paying usual household expenses. And so a lot of these disparate impacts really show up in the data that we're looking at here, where Black and Hispanic households are impacted at a much more severe rate than white households. And so disproportionate data like this affects poor and minority families because of the lack of wealth. If families can't rely on their own means of wealth to sustain themselves through difficult times like a global pandemic, then they lack the support and the resources to lean back on during hard times when they do lose their jobs, when they are facing food scarcity. And this is where you do see throughout these 3 different time periods the higher rates of financial strain on Black and Hispanic communities. Now I'm going to pass it over to my colleague, Anne.
Great. Thank you, Brianna, for that really insightful and well-articulated framing of a lot of the issues that we see today in communities and impacting the lives and the economic lives of Black children. I wanted to share with you some studies that Texas Appleseed has participated in recently that take that framing and show how it's impacting families at a very local level. So about a year ago, we did a deep dive into debt collection lawsuits in Harris County to collect consumer debts. And we also partnered with the African American Community Fund and the San Antonio Area Foundation on a report looking at the state of the African American community in Bexar County that was just released in January. So looking at debt collection, our study called Debt, Access to Justice and Racial Equity looks very deeply at individual lawsuits filed in the Harris County area to show trends and impacts based on the racial makeup of different communities. So you can see in these 2 maps, the map on the left shows the debt claim case filing rate, and on the right, it shows the judgments against defendants. So, and in both of these maps, the very dark purple are census tracts where there's a high proportion of Black residents and either a high debt claim case filing rate or a high judgment rate. And then the moderate purple is a moderate rate, but you can see that predominantly communities where there's a large percentage of Black residents, we also see high debt claim case filing rates and high judgment rates. And it just furthers the dynamics and trends of asset depletion that Brianna talked about in her presentation. And another thing that we did is we documented each of the cases looking at the kind of credit people were having access to and what was driving these debt claim cases, and found substantially higher likelihood of individuals in neighborhoods or census tracts where there was a high Black proportion of Black residents also tended to be targeted by higher cost credit, including payday loans and very high cost finance company loans that can carry rates of 100% or higher here in Texas. And so you see the downstream effects of how these policies in real time are affecting families and their ability to build wealth. I also wanted to briefly touch on the State of the African American Community in San Antonio and Bexar County report. It's a very rich study. It's over 150 pages and includes multiple data points across many different areas. But I wanted to hone in on some of the financial well-being statistics and some of the policy recommendations that Texas Appleseed worked on in this study. So what we found in looking at the data that was collected around financial well-being is many of the issues that have come up in terms of access to capital really played out in the data in the community. We saw that Black-owned small businesses were underrepresented among all small businesses in the Bexar County areas, that their revenues were lower than other businesses or disproportionately low, which also hinders their ability. It's a cycle, because when businesses have challenges accessing capital, they struggle to grow. And when they struggle to grow, they have low revenue, which causes them to have challenges accessing capital. And it keeps the cycle going. And we also saw at the individual level that individuals were more likely to be targeted by high cost credit. Similar maps for the San Antonio and Bexar County looked very similar to the Austin map of where very high cost credit is concentrated, and also experienced more likelihood of having a debt in collection. And so in this report, we have a series of policy recommendations around supporting fair market practices and low cost credit, and expanding access to credit both at the local level as well as state and federal level recommendations. And then I also wanted to highlight some particular demographics within the Black community that really stood out in this report. And as communities where having a particular focus could really have beneficial downstream impacts. One of the communities that stood out are youth 20 to 24 years old, that falls into the opportunity youth category. And we were really struck by the low labor force participation in this group. This is when people are building their lives and starting their lives. And when young people have low labor force participation, it can have a lot of downstream impacts in terms of their ability to have a family, to grow wealth, and to create a financially stable and prosperous future. And so in San Antonio, Black youth 20 to 24 years old had a 55% labor force participation rate compared to 77% for the community as a whole. We also saw that female-headed households struggled a lot, and the median household income was among the lowest of any specific group, and particularly households headed by Black females. So the median household income was a little over $38,000 for Black female-headed households, and over $50,000 for overall for all the female-headed households. So female-headed households struggle overall, but there was a particular issue impacting Black female-headed households. And many of the recommendations we have in this area are around the benefits cliff, which is a policy related to accessing public benefits, where as someone's income goes up, they lose access to support for their children, like access to Medicaid or to CHIP or other insurance supports and childcare supports. And so it creates this disincentive for people to build wealth. And because they lose so much when they start to build wealth, that they're actually worse off as they earn more until they hit a higher threshold. So there are a lot of things that can be done in the policy arena to address that, as well as ensuring that as people's income goes up even a little bit, that they're able to benefit from that and grow from that, rather than losing these key supports that help make their lives work for them. And then the other group that we really saw as one to highlight was veterans. Among the veteran in the Black population in San Antonio, 18 and older, 18.7% were veterans, whereas for the population as a whole in the San Antonio area, 10% around were veterans. So you can see that there are a lot of veterans in the Black population, particularly in the San Antonio area, and that programs targeting that community, whether it be small business development, workforce development, or other financial related and skill related initiatives, can really be beneficial for wealth building in the community as a whole.
So like Anne has said throughout her previous few slides, there are many different policy recommendations that address the issues that do contribute to the racial wealth gap. But we did want to highlight a few key areas that Texas Appleseed is specifically focusing on. So first, reforming predatory lending. Predatory lending disproportionately affects Black people, and we're focused on combating predatory lending by supporting the Veterans and Consumer Fair Credit Act and local ordinances, which do focus and would cap consumer loans to just 36% interest rates, as well as pushing for state level reforms to ensure that Black families are protected from subprime loans and abusive predatory lending practices that have plagued Black households for decades. Our second priority is expanding access to fair credit and low-cost financial services. Black households deserve to be able to access fair credit products and affordable low-cost loans. And so working with banks, credit unions, and other financial service innovators to encourage relevant products is necessary to ensure that our communities that have been forced out of the mainstream financial services system are met with equally beneficial and effective financial products. And we also recommend engaging in the work by the federal banking regulators to update the rules for the Community Reinvestment Act, which is designed to encourage banks to help meet the credit needs of their low and to moderate income neighborhood consumers. And currently this legislation doesn't extend to credit unions, mortgage lenders, and other financial service institutions, which is something that we want to push to change. And then lastly, for this point, we recommend engaging with the Consumer Financial Protection Bureau and their efforts to reduce junk fees, which are exploitative fee charges charged by banks and other financial companies that are costing U.S. households billions of dollars annually, as well as other efforts to protect vulnerable consumers. And lastly, our other policy recommendation is debt collection reform. Currently, if someone owes an old debt in Texas and a judgment is issued against them, then that person can lose all of the money in their bank account, causing them to be unable to cover basic living expenses, and in turn create new defaults on current loan obligations and other financial means. And so we recommend adopting protections for the money in people's bank accounts so that people won't be left empty-handed by a debt collection judgment. Additionally, debt claim case outcomes are largely either dismissals or default judgments, which sides with the debt collector. And with default judgments making up 60% of all judgments in Texas, there's a major concern about fairness and who exactly these court systems are meant to serve, especially because borrowers of color are more likely to be contacted by debt collectors, have debt in collections, and have additional lawsuits. And so this is why we recommend improving fairness in the court process to really encourage people to participate in this system and know their legal rights when being sued by a debt. And so here we've compiled a list of very helpful local data resources, as well as data reports and interactive redlining map tools so that you can learn more about the economic well-being of your own communities. So here's the second page of that. And thank you all again. Please, if you have any questions about anything in our presentation, feel free to reach out to Ann or myself, and we'll really be happy to answer. Thank you all again.